It's 11 minutes past 11 o'clock Central African time. Let's get into our Money Matters feature. When you hear the word debt, you're probably thinking, oh no, I've got so much of it. I don't even know how to deal with it. Then this conversation is not for you. This one is not for you. Deal with that debt and sort it out and get rid of it. We're speaking about those who can manage it and those who actually can identify debt that is actually healthy. That's what we're speaking about today. Good debt. Not all debt is actually bad. There are some types of debt that can actually work in your favor, helping you build wealth, investing in your future, and opening doors to more opportunities you wouldn't otherwise access. We're talking about good debt today. What is it and how do you use it wisely to move your financial life forward? Caroline Marwisa is founder of Master Your Finances, a global personal finance consultancy which is really aiming to build African professionals. Thank you so much, Caroline, for joining us here on Channel Africa.
Good. It's still morning, right? Good morning, Benjamin. Good morning,
It's still morning. It's still morning in South Africa. Where are you joining us from, Caroline?
I'm joining you from Johannesburg.
Okay, yeah, it's still morning. We're in the same hood, so it's okay. We don't have to worry. We have to worry about the other listeners in different parts of the continent. Maybe it's afternoon, maybe it's close to afternoon, but we're still in the morning here in Johannesburg. Caroline, I think that preamble is very important. I think setting that tone to say that if you have stacks of debt, get rid of them because this conversation is probably not for you.
Yes. So I think what I thought I would start with, Benjamin, and thank you for having me. Good morning, Palesa. Good morning, listeners. So I did some research. I think that was around 2015, thereabouts. A professor from Stanford University who went into rural India in 2004. He set up what was called the Grameen Bank. You can look it up and have a look at it. But basically, you're talking about the poor of the poor people. And it was a simple micro-lending concept. He said there are so many women that were entrepreneurial in that environment. He set up a system that would enable them to access loans of $50. And these women would form sort of clubs, and there would be a club leader who would collect the payments when they were due, etc., etc. Mm-hmm. Long story short, what they found with that model is not only were the women able to pay off their debt, so there was like a 99% or a very high percentage of people actually paying off their debt. But what they also found was that 77% of the individuals that were participating in this program significantly reduced their poverty levels, because these were people that were living on below $8 a month, right? And 38% of them were able to go above the poverty line. Mm-hmm. And I thought it's important, Benjamin, for me to share that story, because I know the knee-jerk reaction is debt is bad. I say it's not that debt is bad, you just need to be educated. Mm-hmm. Because the reality is that with debt, you are committing yourself or your future income to a contract that you've entered now. Now, the challenge with most of us is most of that debt that people enter into contracts for right now are contracts that you actually consume immediately. So mm-hmm. basically, you're not using the debt to leverage. So if we had to define what is good debt, it is debt that you utilize to leverage for an even bigger return. So it is debt that will enable you to increase your future income or to increase your assets or your future assets. If you are able to do those two, then that is good debt. Mm-hmm. But the challenge is when you can't, you cannot link the debt that you're taking now to an increase in your future income. You actually don't have a corresponding asset that is actually growing in value. That becomes a problem because you are shrinking your earning capacity by taking on debt, because that part of your income is now committed for the future. So I hope it kind of explains it.
Yeah,
what is good debt.
Yeah, it's very clear. But I'd like us to just have some items of examples. You were very clear, but just as an elaboration.
Okay, so let me give an example, right? So let's take this idea of the India example that I gave. These were women that had businesses. I think most of it was in arts and crafts, that sort of thing.
Mm-hmm.
I think making baskets and that sort of thing. But the ability for them to actually produce more of those was tied to the capital that they had access to. So if they had to work off of their own pockets, let's say the person can only do one basket a day and the profit on the one basket is like 10 Rand, for argument's sake. But now you have this cash injection, you have the $50, it enables you to produce not one, but maybe 10 per week or 100 per week. Can you see how suddenly the profit you are making 10 cents per day, you've now multiplied that by 100. So in a scenario like that, where you've got an entrepreneurship venture, you've got a business, some kind of business, where you've got a ready market, you've got a product, and the money enables you to fast-track your activities, that is good debt. So that could be one example. Another example could be you are taking on debt to increase your future earning capacity.
Yeah.
So let's say you finished school, or you finished your degree, but maybe there's another degree, maybe just a 1 year or 2 year degree you can do to really boost your skills and boost your income by 30% or something like that. Why would you not take that? Mm-hmm. Because you don't have the money to pay for it. If you can afford to take the debt, get the qualification, after 2 years, your income is up by 30%. You've actually bought yourself years in income, because had you stayed at the level that you were at, you would not have been able to actually command that higher income. And you find that maybe give yourself another year or so, that debt has been paid off. So that's an example of debt that you can take to increase your future income. Another example could be, property. We like, the property example, because especially in a market like this, where it's a buyer's market, you can really get good bargains of property if you're able to set up the property such that the rental income you're obtaining from the property is much higher than what you need to pay for the bond and what you need to pay for your utilities. That's also another way of creating wealth using debt. So those would be some of the examples that I can cite. But it's a principle thing, right?
Yeah.
To say, if I look at it over time, I take let's say I take a loan of 100,000. Yeah. I have to pay it off over 5 years. Over 5 years, if I work out the interest, let's say for argument's sake, it's another 20,000. So after 5 years, I've actually spent 120,000. Mm-hmm. If I apply that 100,000 to something that's going to give me 150,000, 200,000 after 5 years, that is good debt, because I'm working with time, I'm working with this debt, I'm using it to transform my situation, whether it's my income, it's my assets, it's my businesses, to enable me to generate more income in the future. So that is good debt. I think, to balance that, Benjamin, the challenge, I think, with debt is also the fact that on your side, once you enter into the contract for a loan, yours is fixed and you now have an obligation to pay it off.
Okay,
right?
We'll come back to that after the break. I'd like us to get into that investigation. You're going right where we need to in terms of the responsibilities that you have when it comes to the good debt. Stay there on the line, Caroline. Very articulate. Thank you for breaking it down in layman's terms, because we're understanding what you are saying, and you're very clear in how you've distinguished this good debt. We're speaking to Caroline Marwisa, founder of Master Your Finances. We'll come back and continue the conversation after this break. This is our Money Matters feature.
Celebrate unity, progress, and pride with Channel Africa this Africa Month.
Nowhere be like Africa, nowhere be like home.
Listen in on SABC Plus, DSTV Audio Bouquet 802, and Satellite Channel PAS 10.
Benjamin Moshatama and Palesa on the move. Debt, debt, debt. It sounds like something that's often very frustrating for many. But today, we're taking a look at good debt on today's Money Matters feature. That's where we speak all things personal finance. And we still have on the line with us Caroline Marwisa. Caroline Marwisa is the founder of Master Your Finances, a global personal finance consultancy aimed at the African professional. And she speaks to us about what good debt actually looks like. We've got a few examples from you before the break, Caroline. And usually when people are able to access good debt, these are usually people who are not drowning in debt as yet or have never drowned in debt. And because obviously you need to be trusted with that debt in the first place. You will not receive debt from any bank or any financial service provider if you can't prove that you can pay it back. But there's a thin line between good debt and getting yourself in a really uncomfortable position. What are some of the red flags that we need to look out for that can turn good debt into financial quicksand?
Thanks so much, Palesa. I think when I was chatting to Benjamin earlier on, I explained that, sometimes we fail to do the math, right? I know there's a time that people used to talk about property and it was like, yeah, property is a good investment. So I know I'm one of those that made the mistake of just going to buy property because they said property is a good investment until I then learned that actually you need to do your numbers, right? So you need to do your numbers. What I was trying to explain is that when you enter into a contract for a loan, whether it's on your home or it's a car or it's whatever type of loan, you are entering into a contract to commit your future income. Because typically you are saying, I'm taking this amount of money, I'll repay it with this percentage of interest over this period of time. So let's say it's 5 years, it's 20 years, it's 30 years in the cases of a property. What you now need to do is the ability of making sure that, number one, you can predict the value of that asset. That's why, Palesa, you're talking about the fact that the people that lend money will want to prove that you're able to, that the investment is safe actually with you. So one of the things is they look at the loan to value, the loan to value ratio. Basically what that is you're asking for a loan of R1 million. They want to know that the property is at least 1.2 million rand or higher. Then they want to bet their, they want to hedge their bets. Should something happen because we're relying on your salary income, you're not able to pay off that debt, then at least I've got an asset I can go and sell, right? So the same process, I talk about becoming your own banker. So the same process that bankers go through in deciding whether to lend you money or not is the same process as a person borrowing you need to go through. So one of those things you can check is the loan to value. Is there a buffer between the amount I'm borrowing and the value of this asset? And what's likely going to happen to the asset that will either increase its value or decrease its value? So that is important. Ideally, you want to borrow R1 million today and you know that this asset is worth, let's say, 1.2 million rand. In another 5 years, it's going to be worth 1.5 or above, right? Then you are reducing the debt that you owe, and you're keeping a big distance between the value and the loan that you're borrowing. One of the red flags is where you can see that the value of your asset is coming very close to the loan that's outstanding. That for me is a red flag because you're not giving yourself enough room. The other red flag becomes something around the actual interest rate that you're paying. I know, like before, around about COVID, etc., interest rates were much, much lower, right? And that gives you the sense that, I can afford this, I can afford that. But should interest rates increase, right, you always have to work with at least 2 or 3% higher to ask yourself, can you actually afford to repay this thing? I know in our lifetime, maybe it was 20, 25 years ago or so, our interest rates got as high as about 24%, if I remember correctly. So the fact that our interest rate is 10%, 11% now, should not give us the comfort that it's going to be like that forever. Interest rates can increase. So when people are taking out loans, I recommend that, not only should you be paying more than the minimum amount, but also do that calculation to say, and you can ask your banker, right, whoever is offering you the loan, should the interest rate go up by 3%? what is the repayment amount, and then you figure out whether you can still afford it. So interest rate is also another important thing. And the period that you're paying off the loan is something that's quite important, because I've come across a lot of people I've coached, Palesa, who say, no, but I've been paying off this this debt for the past 5 years, but I borrowed this amount, it's still stuck there. I'm like, because people don't understand that when you're borrowing money, there's a rental that you pay for using someone's money, because you're basically going to the bank and saying, please, can I have this R1 million now so that I can go and buy a house so that I don't have to pay rent and I can live in the house. So the rent that the bank is charging you is called interest. And sometimes when that interest amount is very close to sort of your repayment amount that you're making, you find that you're actually not making a dent in your debt. Your debt remains, at that high level, though you've been paying for all these years. So those are all things that people need to, they need to look at, in terms of from the loan itself. How are the numbers? Do they actually make sense? And then from the stability of your own income, does it make sense? And if you're going to borrow for a business or, for investment property, make sure that the numbers also make sense, that that property can stand on its own. It won't rely on your income from other sources again for it to stand. So you want to enter into deals that will give you cash flow in the shortest amount of time.
Yeah.
So I think those are some of the things that are important to look out for.
I love that. And it really does take, I think, a lot of strategy to use good debt. And as you said, you need to do your research and you need to assure that you're making a solid financial decision when using this kind of debt. How can the average person use good debt to build a solid financial future, especially without falling into the trap of over leveraging? We have around 2 minutes left, Caroline.
So I think the most important thing I always say, Palesa, your two biggest instruments you have to build wealth is your income and your assets, right? So whatever transaction you're entering into, just ask yourself, what does this do to my income? What does this do to my assets? If you find that whatever structure you've entered into helps you to increase your income, I think that's good debt. If you find that you're increasing your asset base, that I also think that's good debt. But I think there's also playing it safe in terms of the percentages. So you don't want to say maybe your total assets are $1 million and you've got $1 million in debt. I think that's quite risky. You want to leave that buffer that we spoke about. So making sure that your debt to asset ratio is within appetite, and it's maybe something like, less than 50%, if I can say, just to give guidelines. And then you've got enough buffer to be able to pay off whatever commitments you have from those debts, even if, your income has a bit of a dip. That's what I would say. I think the last thing I would say, Palesa, is people also forget to think about some of the hidden costs. So we just look at the cost of the bond, the repayment, but you forget that there are levies, there are insurances, there's cost of maintenance, all of those things. So, just put in all of those in your numbers, and you'll find that you can safely use debt to increase your wealth, as the ladies in India managed to do.
Well, thank you so much, Caroline. It's always a pleasure to chat to you. Where can we go to find out more about Master Your Finances and to find you?
Thank you, Palesa. I have a website, www.masteryourfinances.net, and I'm also available on LinkedIn as Caroline Marwisa.
That's the founder of Master Your Finances, a global personal finance consultancy aimed at the African professional. Her name is Caroline Marwisa, helping us to understand good debt. It's 11:30 Central Africa time. We have Musibudi Makura back with our latest sports.